Okay. Hold on, I'm gonna move it to the other so I'm not looking away from you guys when I'm presenting. One second. Okay. Share. Okay. So today we want to talk about business taxes. I've done this presentation, like you said, on the Wisdom Wednesdays, but I added a few tweaks to it so that we could put actual numbers to it and really make the different structures make sense. So we're going to talk about today is how can you be set up as a business? How should you be set up? What's the pros, the cons? And then we'll break down into some other individual business topics and hopefully have some time for some questions at the end. All right, so this is a little bit about me. He already kind of gave you the bio, so I'm going to skip past that. So the first thing that we're going to talk about, like I said, is how can you be set up as a business? So there's a couple different ways that you can be structured, okay? So the first way that we talk about is what's called a sole proprietorship. And you can think about that as sole meaning one, right? So that's one owner and it's not incorporated, and so for tax purposes, the owner and the business are treated as one and the same. Okay. So that means that this business goes on your personal taxes, just like your W-2s, your kids, and everything else, right? You don't have to file a separate business tax return. Okay. It's just a separate piece of paper that goes on there called a Schedule C. Okay. And that's where we will put your income from your business minus out any expenses. Whatever's left is what's called your profit or your loss. Okay. This is the default way. So even if you don't register your business, say you're just doing DoorDash, Uber Eats, or you're cutting hair or doing hair, and maybe you haven't actually registered the business. If you're making money and it's not a W-2 income, you're still considered a business, you're still considered a sole proprietorship, and this would be the way that you would file your taxes. Okay. And we'd add that into whatever income you have. So, like I say, your W-2, your spouse's W-2, and then your business all gets added up together. And then whatever ordinary tax bracket you fall in, 10%, 12%, whatever, that's what your tax would be. But the kicker is when you're self-employed, you also have to have an extra tax called self-employment tax. Okay. And that tax is 15.3%. And all that really is just Social Security and Medicare. So it's a way for us as self-employed people to pay into Social Security and Medicare. So this is the easiest way, the default way to file your taxes, okay? The next way that you could be set up is what's called a partnership. So again, if we said sole proprietorship was one, well, then if it's two people setting up a business, that's going to automatically default to being a partnership. So if me and Joseph said, hey, we got this great idea, we want to go into business together, we would set up what's called a partnership, okay? And we'd have a partnership agreement, which is very, very important. I see a lot of people that set up partnerships with people and they don't spell out any type of agreement. And then when things fall apart, they're not feeling each other anymore or whatever. That partnership agreement, if you get that filled out in the beginning, is going to spell all of that out. What happens if one partner wants out? What about can we bring in other partners? What if we can't agree on something? All those things would be spelled out in that partnership agreement. So that's very, very important to get that on the front end so then you're not having to deal with situations on the back end. Okay. And that would even be if you're a husband and a wife partnership. We see those a lot, right? So because me and Joseph, like we talked about, we don't file personal taxes together, then how are we going to file this business, right? Well, that means the business has to file its own tax return first, which is called the partnership return. Okay. So let's put some numbers to it. Let's say me and Joseph, we had a business. Our business made $10,000 after we take out our expenses. And so we're 50-50 partners. So he's going to get a form called a K1 with $5,000 on it. And I'm going to get a form called a K1 with 5,000. And that K1 is what we put on our personal because this particular structure is what's called a flow through entity. So what that means is that the business doesn't pay the tax. We just do that return to figure out what the profit or loss is. And then that flows down to the partners, and then we still pay the tax on our personal side. Okay. But because of that, these returns are due March 15th, and our personals are always due April 15th, right? To give us time to get the K1 and file our personal. So if you set up a business as a partnership and you don't have your stuff together for the business, you can't run off and file your personal. You can't file your personal till the partnership is done. Okay. So if you file extension on one, probably going to have to file extension on the other if it's not ready by April 15th. Okay. We see that happen a lot. All right, tax-wise though, once you get that K1, whatever your share of the profit is, it's taxed exactly the same, whatever your ordinary income bracket is, plus the 15.3% on the K1, okay? The next way, and this is the one that's all over TikTok University and YouTube University and all the ways, is the S corporation. It's actually not a set structure, it's an election you can make. So the sole proprietorship could be an S corp, the partnership could be an S corp. It's a form you file with the IRS, this 2553, that tells them, hey, I know I'm this way, but I would like to be taxed this way. Okay. And the same thing, it's a flow through entity, just like the partnership. So it doesn't pay any taxes, flows down to the owners, but instead of being called partners, we're called shareholders. It's really a big difference between those two. And it can be one person, so 100% owner, all the way up to 100 people. It's more than 100, it can't be an S corp. Okay. And same thing, we're going to do the business return. Whatever our share of that profit is going to get on the K1 by March 15th, come over to our personal. Okay. The big difference, though, and the reason everybody online says to be an S corp is because you don't pay the 15.3% self-employment tax. That goes bye-bye. Okay. The part, though, that a lot of people leave out when they're telling you this stuff online is the reason why that goes bye-bye is because you're supposed to put yourself on payroll and pay yourself a reasonable salary, right? And if you're doing that, then you're going to already be paying into Social Security and Medicare on your W-2, right? Because that's what we do. So that's the piece that people leave out. So it's not just always cut and dry. Oh, I ain't got to pay 15.3, so I'm going to be an S corp. Okay, but are you making enough money to even put yourself on payroll? Are you not commingling and mixing your business stuff with your personal stuff? Because it's this way, we should not be doing that, right? So we're a whole separate entity. So there's other factors. So me personally, I don't just throw people here. You have to be making enough for this to make sense. So just because that tax goes away doesn't mean it's always going to save you. And we're going to look at an actual example in a second. The last way that you can be structured is what's called a C corporation. And so this one is its own complete separate entity. So there is no flow through to you. The business actually pays the tax, and it is a flat tax. So you don't have to think about how much you owe or what it's 21% flat tax. The only way for you, though, to get money from this business, if you as the owner need money, is that you need to, again, put yourself on payroll. So you'd have a salary from the corporation. And then at the end of the year, if the business has a profit, it can pay you a dividend. So think like, you know, how if you have stock in Disney or you have stock in a company, when that company makes money, they pay their shareholders a dividend. It's the same premise, okay? You don't have to be a huge, large corporation to be a C Corp. Anybody, I could be a C Corp, you could be a C Corp. The thing though is if the business is paying the tax, flat 21% on that income, and then they turn around and give you, the shareholder, a dividend, now you're going to pay tax on that dividend. So in a way, if you're the owner and the corporation, that's getting double taxed. So that's a lot of times what people don't want to be the C corporation. So it's pros and cons. Again, doesn't mean that's necessarily more. It just is a situation of you want to try not to be having to draw those dividends out if possible. This strategy is very good if you're trying to scale a business, which means you're trying to grow the business, right? Maybe you're trying to franchise it out or you're trying to have multiple locations where everything that business is making, you are reinvesting back into the business. That's when this would be a great tax strategy, right? Okay. The last thing that I talk about is LLCs. You notice I didn't say it was a structure, and that's because LLCs are not a structure. It doesn't have anything to do with how you're taxed, and people confuse that a lot. When I get new business clients and I say, okay, well, how are you set up for taxes? How are you structured? Well, I'm an LLC. That don't tell me anything. I have no idea what you're on. So an LLC can be any of those ways we just talked about. All the LLC is a legal protection on the state side of things. So when you go to the state Secretary of State and you create your LLC, it is a liability protection. So basically, think of it like it's putting a buffer between you and the business, right? So if someone wants to come after you, Joshua, they don't like how you did this conference and they are pissed off that they spent their money and they don't like it, right? They want to sue you. Well, if they do, they can, oh, and you have an LLC, they can only come after the things in the business name. So the business bank account, business assets, things like that, not Joshua's personal home, personal car, whatever. Earlier, I used a word though, commingling. That word means where we mix business and personal stuff together, right? They're commingling, mixed all up. So that means I go to open your business bank account and I see the barbershop in there, and I see the hairdresser, and I see the grocery store, and I see all these things in there that are really not business expenses, right? That's commingling. We're not supposed to do it, but this is a big reason why we shouldn't do it. Because if you have an LLC and you're mixing and mingling and we go to court, the lawyers can say, oh, wait, no, there's personal stuff. The mortgage is getting paid out of this business account. So we should have access to that as well. Put that in the lawsuit, right? That's what's called piercing the corporate veil, because basically you've wasted your LLC by doing that. So it's very important we try not to. Now, I want to pause here and just say it does not mean you can't take money from your business bank account to use personally. That's perfectly legal. But we want to transfer it from the business bank account to our personal bank account and pay the bills there. We don't want to have those bills coming out of the business bank account. Okay. And so that's another reason why I don't just throw people to S corps, because a lot of times when a person first starts a business, we were really not making no money. So there is a lot of commingling going because you're trying to pull from here and pull from there and this and that. So we want to get that cleaned up before we start working over our way to those other things. Okay. And every state has different rules for LLCs and different filing fees. I have a little worksheet that shows like what the initial startup fees per state and the annual fees are. So if somebody would like that at the end, I'll have my contact information and I can shoot that to you. I'm here in Kentucky. Ours is 175 every year, but every state, is different. All right, so now what we're going to do is we're going to look at Susie Smith. She is going to be our tax client, and we're going to look at the same income with Susie, but we're going to look at it with the three different structures so we can try to see how that plays out with the numbers, okay? So Susie's business is the Computer Diva LLC. She's an IT consultant. She's single. Now, again, this is very basic, bare bones. We are not taking account if Susie has kids, if she qualifies for credits or any of that. This is just straight the income and the taxes, okay? So Susie made 82,000. She had 20,000 in business expenses. So her profit was 62,000, okay? So those are the numbers we're playing with. And now we're going to play those across the different scenarios. Okay. So the first one is the sole proprietor we talked about. Remember, it goes on your personal tax return. You pay your ordinary income tax bracket, plus you pay the 15.3%, right? So if this is Susie, her regular income tax on that 62,000 will be $3,899, okay? But here's that kicker. Look how much that self-employment tax is for her. $8,760. So if I'm doing Susie's taxes and she is set up this way, then Susie needs to be taking what we know that she's probably going to owe, this 12,000, dividing that by 4, and that's what she needs to be sending in every quarter for her estimated taxes, so that at the end of the year, she's already paid in that and we're just a wash at tax time, okay? We don't want Susie to have to be trying to come up with all this all at once, okay? The
Hey,
next,
Toya. Hey,
yes,
Toya, are you sharing like a present? I can't see anything. Like,
nobody can see it.
I
No,
just
we can
see
see
your
it.
picture.
No, we can see it. You're on audio only. And so if you want audio only, you probably need to go back to Zoom and refresh your Zoom or update it because we had what one or two people that had that issue on
Okay.
Friday. So you got to log out, update your Zoom, and come back in.
Okay. Thank you. I'm sorry. Thank you.
Everyone else can see Toya, so we're good.
Okay. Okay. So S corporation. So we just talked about at the S corporation, she has to put herself on a salary, right? So we're going to say she made the 62, but we're going to say now in this scenario, because she has to pay herself a reasonable salary, Susie made herself a salary of 25,000. Okay. So if she had 62, we minus out the 25,000, then on her K1 or her profit from her business is now only showing 34,000. And that's because not only does she get to subtract the salary she paid herself now as a business expense, she also gets to write off her employer portion of the payroll taxes. So that becomes all deductions to her. So now instead of showing 62,000 profit, Susie is showing $34,413. Okay? So then we go to do her personal. On her personal, on the salary and the K1, we add up all her income together. Her income tax was 4,319. But here's the thing. Susie's been paying herself a salary all year, which means she's been paying into taxes on her W-2 all year, right? So she paid in 3,825 already. Okay. And the SE tax on her is zero because the self employment goes away. So that's a lower tax bill, number one. So if we filed her taxes at the tax return, she would owe the 4,000, she'd owe the difference between these, which would be 4,319 minus the 3,825. So she wouldn't hardly owe anything. So that saved her quite a bit being the S corp. But again, she had to have enough money to pay herself the salary. She had to timely file her payroll taxes and pay those in, right? And so, how I try to do with my clients is based upon their living situation, how much they need. I try to overpay in on the W 2 so that at the end of the year, hopefully, we just break even so that they don't have to do estimates or anything like that. Okay. The last way, same thing, C corporation. We're going to have the same $25,000 salary, but because that business had a profit, it's going to also give Susie a $25,000 dividend. Okay, so we said the business has already paid the tax on her profit. That was 7,368. So when she goes to file her personal, her income tax is only 1,043. She's already paid in 38. So Susie actually would get a refund if she was set up this way, right? But the business had to pay this, and she also had to pay the self employment tax. So her tax bill is still higher, right? So again, I'm not using this example to say it's a one size fits all that every single person should be an S corp just because of this. There's planning that goes in all these stages. If Susie was a single mom and she had 3 kids and she could qualify for earned income credit and things like that, I'd probably keep Susie right here as a Schedule C because that income is going to get her credits for her kids and then that'll pay the tax for her. So there's no reason for me to switch her to the other way. Or if Susie wasn't making enough money to make this make sense, same thing. I would keep her this way. So we just look at everybody's situation case by case. I just wanted you all to kind of have a general overview understanding of the different structures. Okay. All right. So these last couple slides now, we're just going to go into some other tax topics. So sales and use tax. Everybody should be aware of what sales and use tax is. That's when we buy things, right? So if you go to Wendy's, McDonald's, you buy something, they add in Kentucky it's 6%. So they're going to add that onto your taxes, right? Well, here in our state, they're starting to add sales tax to service businesses. So now cleaning businesses, tattoo artists, if you do event rentals or events, hosting events, things like this, you're supposed to charge the sales tax, right? And then hold on to that and then pass that over to the state. So I like to make people aware that if you are in a business, whether you're selling retail items online or whatever, and you are supposed to be collecting that sales tax, make sure that you are then turning that sales tax over to your state authorities. And not all online shopping sites do it for you. For instance, Shopify does not pay your sales tax for you. They'll collect it. Like, so when you build your Shopify store and all of that, they'll collect the sales tax, but they don't remit it or give it to the state. You still are responsible to do that. So you may not be doing something you're supposed to if you have Shopify. Now, if you sell on Etsy, eBay, Amazon, those are considered third-party marketplaces. They're going to do that for you, right? But a lot of the smaller things are not. And so if you're not sure, have questions, again, we can help you with that. Other business taxes to be aware of is local occupational taxes. Again, I know people here are from all different states, so every state is different. In Kentucky, we have local occupational. So for instance, I'm in Louisville, Kentucky. When I work a W-2 job in Louisville, I have to pay Louisville taxes as well as Kentucky taxes, right? Comes out of my paycheck. Same when you have a business. You have to pay the locality that you operate in as well as the state. In Ohio, for instance, they have school districts. So I'm sure y'all hear that. So in Ohio, you have school district taxes that come out. So all states are kind of different. Indiana is counties, so they pay the county taxes. So every state has kind of like different rules, but just be aware that it's not just filing your one tax return and that's it. Sometimes if you have a business, there may be other things that are required. Also, your Secretary of State annual reports. Again, like I mentioned earlier, for those that weren't on here, I have a little worksheet that shows each state what the filing fees are originally to set up an LLC and then what your annual requirements are, because every state's different. Here, it's $15. So you go on Secretary of State, there's a little yellow button, you click it, pay your $15, tell them the business is still the same, you keep your LLC in good standing, okay? And then the last thing to be aware of is payroll taxes. So again, in our example with Susie, if Susie was on payroll, Susie's taking the payroll taxes out of her paycheck or maybe her employee's paychecks. She has to then turn that over to the state, to the IRS, whatever, for those taxes. You're not supposed to keep those. It's probably one of the most serious taxes you can get in trouble with the IRS because that's not your money. They're trusting you. That's what they call it, trust fund. They're trusting you with that to take the money out the employees' checks and then to turn it over to them. Okay. So that's very important. We have payroll software as well as we do full service payroll. So if you have payroll questions, again, we can help with that. Now, the part everybody wants to know, what can I write off if I'm a business, right? Can I just write off everything, Toya? I mean, I'm going on this fabulous vacation. I want to write it off. Can I do it? Well, it depends. So the tax code says that it needs to be ordinary and necessary for your line of work, okay? So if I'm a nurse and not a W-2, we're talking businesses here only. So if I'm a contracted nurse and I want to write off scrubs or medical equipment, perfectly legal, right? Because that's ordinary and necessary for what I'm doing. But if me, the accountant, said, hey, I'm writing off these scrubs or I'm writing off this stuff, that's not ordinary or necessary for me. Okay, so we'll go over some of these main topics, or main categories. But again, if on all the forms, there's a whole section that says other. So just because it doesn't fit into one of these main categories doesn't mean you can't write it off. Just means we need to make sure that it's ordinary and necessary for what you're doing. Okay. So advertising, obviously. One thing to note is now in the day of social media, if you are boosting posts or paying for your Canva subscriptions or paying a social media manager or any of those types of things, that's all considered advertising. That is all a write-off. Okay. Legal and professional. So if you come to me and you need me to help you set up a business, you pay me to do that. That's legal and professional. You can write that off. Okay. Or you go to a lawyer. We were talking about that partnership agreement. You go to the lawyer, have them draw up your partnership agreement. That's a write-off. Okay. I'm going to come back to home office. Insurance. So this is like, for instance, mine is about to renew. I just got the email. So I have to have liability insurance as well as errors and omissions insurance. So that if I'm human, I make a mistake, my insurance can cover that, right? So those insurances are all considered a write-off, okay? Or if you have a building that you own, you can write off the insurance for that. Repairs and maintenance, same thing. Now, again, this is like if you have like an actual building or office space. If it's in your home, you only get a percentage of that. We'll talk about that in a second. Taxes and license. So that $15 I said in Kentucky, our LLC taxes, the 175, all that's a write-off to you. Meals. Meals, we only get 50%. And they do that because they know we all writing off meals that really ain't business meals. So they just cut it in half because probably ain't business meals anyway. You want to try to get in the habit, and this is what I try to do when I go out to eat or whatever. I ain't gonna say it's always 100% business, but again, if I'm meeting with somebody or I'm gonna write on the top of that receipt, met with such and so, snap a picture of it. I have QuickBooks where I can attach the receipt right then and there, and then I've done my due diligence, right? Keeping track of who you're meeting with, what you're doing. But if you buy donuts for the office and bring that in, or like in my office, we give out waters and coffee and things like that. Anything you're doing to buy for the clients or for the office, that's all perfectly legit. Okay. So now on the home office, let me see if I know I didn't. Let me go back. Okay. So on the home office, you only get a percentage. So if you have, like right now, I'm at home. So if I have an office space at home, then that we have to figure out what the square footage is of your office space in comparison to your whole house. And then you can get a percentage, whatever that divides out to. That's what percentage you get of either your mortgage or your rent, your utilities, repairs and maintenance, all of that. You get a percentage of it. Now, if you do something specifically to your home office only. So say you just paint that room, you can have that at 100%. But anything that's done to the whole house, you get a percentage of, okay? Yeah. And then vehicles. It talked about contract labor on here. I just wanted to mention that. So if you pay someone to do work for you, and they're not an employee, maybe again, you got somebody that came and built a website for you, or your social media manager, or something like that, and you pay them a monthly fee or whatever. At the end of the year, you can give them a 1099 for what you paid them, right? It used to be $600. So if you paid one person more than 600 throughout the year, you're supposed to give them a 1099 in order for you to write that off as an expense. Okay. And then they take that 1099, count that income on their taxes. For his one big beautiful bill, he bumped it up to 2,000. So for 2026, it's $2,000. So you only have to give 1099s to people when you pay one person more than $2,000. And again, we can help file the 1099s, whatever. But what you want to make sure you do is there's a form called a W-9, and we have blank ones if you want it. You can Google it, whatever. You want to give that to the person before you ever pay them. Because what that does is that gives you their name or their business name, their social or their EIN, and their address. And that way you have that. So then come January, when it's time to cut the 1099s, you're not hunting Susie down, and Susie don't want to put that on her taxes, so she ain't trying to answer your call or give you the information or whatever. And now you can't write it off and you got to eat it because you can't get a hold of her. So make that transactional. You want this check for me or this Cash App or this Venmo? You're going to fill out this W-9. Okay? Because I shouldn't have to pay the taxes and you not pay any taxes. Okay? All right, vehicle expenses. So vehicles, there's two ways that you can do vehicles, either actual or the standard mileage rate. So actual is literally what it says. Like we take the actual cost, the actual gas you spent, the actual repairs, whatever. And then we do what's called depreciation on the vehicle. So all depreciation is whatever the thing costs. And then the IRS has a life cycle for everything. So vehicles, they say, are 5 years. So you would take whatever that vehicle costs, divide it by 5, and you get a chunk of that each year. Okay, that's how that works. So that's actual. Or you do standard mileage. So every year they come out with the mileage rate. Last year it was 70 cents per mile. So you multiply that by however many miles, you keep a mileage off. Does not have to be anything high tech. I do have apps and stuff that I partner with, but it could be a notebook, literally, that you have in your dashboard and you write down, or a note in your phone. And every time you go somewhere related for business, you write that down. Okay. Whether you do actual or standard, you still need to track your miles. Because if that vehicle is not 100% work, how else am I going to know how much of the gas to give you, how much of the oil to give you? So I still need that mileage number. Okay. So it's good to get in a habit of in January writing down where you started for the year, or in December where you ended, whatever. So then at least we have a starting and an ending point. And then in between, we can fill in where you went or what you did. Last couple things to talk about. So, like I said, we've heard all in the news that he passed what's called the One Big Beautiful Bill last year. And so there were a lot of tax changes in that bill. So, some things to note on the individual side is that if you are over 65, so senior citizens, there's an extra deduction. This is a typo. It should say 6,000 per person. So it's 6,000 per person if you're over 65, extra deduction that you get to take. So that's been helping a lot of the seniors this year. The child tax credit. So if you have children under the age of 17, that went from 2,000 per kid to 2,200 per kid. Okay. The daycare credit. So that's one that you don't hardly get much anyway. The max credit's like 600, no matter how expensive daycare is. But he did increase the base, so now more people are able to actually get to use the credit. The last three things that are big for the tax season this year was the SALT cap. SALT stands for state and local taxes. So if you itemize your deductions, then you can write off like your mortgage interest, your property taxes, your donations to charity, all that good stuff. Well, the tax portion, you can write off the state taxes you pay throughout the year on your W-2, as well as your property taxes on your house and your vehicle taxes if your state does vehicle taxes. That used to be capped at $10,000, and people was pissed about that, especially in the expensive states like New York and California. Their property taxes are insane alone by themselves. So they were leaving a lot of money on the table. Well, for the One Big Beautiful Bill, the cap got raised up to 40,000. So I did see that help some of my married couples who were higher earners that own a house and stuff being able to itemize this year. And then the two that helped quite a bit also was the no tax on tips and the no tax on overtime. So if you are a server or you do any type of work where people tip you, you could write off up to 25,000 of the tips. So like you got to basically back that off your income before we figured your tax. Same with the overtime. Now with the overtime, it was not all your overtime that you worked all year. Okay. You were supposed to look at your pay stub if your employer didn't give you the dollar amount. It's basically the half portion because when we work overtime, it's time and a half, right? You get paid time and a half. So it's only that half part that you get to write off. Okay. So if you're looking at your pay stub for 2025, and it said year to date, whatever dollar amount there for the overtime, divide that by 3, and that would give you the amount that you could write off for the overtime for the year. That did help a lot for my single people because as y'all know, taxes suck for single people because you don't really have anything to write off. It is what it is. So my son is in that boat, but he worked a lot of overtime, so he actually was able to get a nice little refund this year because of that overtime thing. And then the last thing is that you can write off car loan interest, but it had to be a loan that was established in 2025, and it has to basically be a new vehicle. It has to be a new vehicle that was manufactured in the US. So it can't be like a used car. But if you bought a new US manufactured vehicle in 2025 and going forward, all these changes stay in effect until 2028. Okay. And they'll have to vote and decide if it will keep going. So then you can write that off. Let's see. All right. And so then lastly, this is everything that we help with at Truth Tax and Accounting. So we do bookkeeping, business consultation. This presentation I gave y'all, I added a few things, but this is a free new business consult that I do with my clients because I'm big on us knowing things. So we should at least understand the basics. You ain't got to know the whole tax code. That's what I'm here for. But we should have our basis to know oh, okay, that makes sense. I understand. And then going forward, hey, okay, I understand it, Toya, but I still want you to do it for me, girl, because I don't want to fool with it, right? But we need to at least understand. I'm building out some tax academies right now. So I will be starting to advertise a course on the 1040, like basically going through all personal taxes, breaking it down for you so you understand exactly how it works. And then I will have one for people who want to learn the business side of tax things going. We offer payroll. We do all taxes, not just businesses, individuals, everybody. We can do all 50 states. We do virtual, so whether you can't get to our office, and then software training. Sometimes people like, hey, I can file my sales tax if you just show me how to do it. So, okay, boom, you pay me for 1 month, I show you how to do it, you're good. Or same with QuickBooks. I got QuickBooks, but I don't know how to use it. Okay, good. Let's do a month or two together, and then you're good. Right? So I don't mind to train and show people things. So here is my contact information. Phone, that phone you can call or text. On social media, Facebook is Truth Tax. On Instagram, it's Toya Traynor _Truth Tax. But if you scan this QR code, it takes you to all my social media links, the website, every single thing.